Advanced Audit and Assurance. Table of Content. Introduction. Chapter 1. The Nature and Purpose of Audit and Assurance. Chapter 2. Professional and Ethical Framework. Chapter 3. Audit Planning and Risk Assessment. Chapter 4. Internal Control Systems. Chapter 5. Enterprise Risk Management (ERM). Chapter 6. Information Technology and Audit. Chapter 7. Audit Evidence and Sampling. Chapter 8. Substantive Procedures and Analytical Review. Chapter 9. Group Audits and Component Auditors. Chapter 10. Audit of Financial Institutions. Chapter 11. Audit of Public Sector Entities. Chapter 12. Audit of Nonprofit Organizations. Chapter 13. Forensic Audits and Investigations. Chapter 14. Internal Audit and Risk Management. Chapter 15. Emerging Trends in Audit and Assurance. Chapter 16. The Future Auditor's Role and Skills. Epilogue. The Unseen Guardians. Introduction. Every set of financial statements tells a story. Sometimes that story is one of growth and success, rising profits, strong cash flows, and a healthy balance sheet. Other times it is one of struggle, shrinking margins, falling demand, and hard decisions about the future. But whatever the story, investors, regulators, employees, and society rely on it to be true. The problem is numbers can lie, or at least mislead. Mistakes happen. Systems fail. Sometimes people manipulate the truth to make results look better than they are. When this happens, trust is broken, decisions are flawed, and the consequences can be devastating. This is where audit and assurance step in. Auditors are the quiet guardians of trust in the financial world. Their job is not simply to check figures, but to test reality, to ask hard questions, and to shine a light on anything that doesn't add up. They stand between management and the public, providing confidence that what is reported can be relied upon. But modern auditing is far from simple. Today's businesses are complex, global, and technology-driven. They generate oceans of data and face a growing list of risks, from cyberattacks to climate change. The world is changing, and the audit profession is evolving with it, using new tools and techniques to keep pace. This book, Advanced Audit and Assurance, takes you inside that world. Across 16 chapters, it explores how audits are planned and executed, how evidence is gathered and assessed, and how auditors form the opinions that shape public trust. You will journey through the challenges of group audits, forensic investigations, and public sector reviews. You will see how technology is reshaping the profession, and what skills future auditors will need to stay relevant. This is not just a technical manual. It is a narrative about responsibility, skepticism, and courage. It shows how auditors contribute to the stability of markets, the accountability of governments, and the confidence of society. By the end of this book, you will understand that auditing is not just about numbers, it is about truth, and the professionals who dedicate themselves to finding it. Chapter 1. The Nature and Purpose of Audit and Assurance. Auditing begins with a simple question: can we trust what we are told? Every day businesses produce numbers: profits, expenses, assets, and liabilities. Shareholders rely on these numbers to make decisions. Lenders use them to decide whether to provide credit. Regulators use them to protect markets. But what if the numbers are wrong? Or worse, what if they are intentionally misleading? That's where the audit steps in. An audit is not just a checklist or a compliance exercise. It is an independent professional investigation designed to give confidence that the financial statements reflect reality. The word audit comes from the Latin audire, meaning to hear. In its earliest form, auditing meant listening to accounts being read aloud and confirming they were fair. Today, auditors listen to the numbers in a different way, through analysis, questioning, and testing. The purpose of audit and assurance is to reduce information risk, the risk that users of financial information will make decisions based on incorrect data. Auditors provide reasonable assurance, not absolute certainty, that the financial statements are free from material misstatement, whether due to error or fraud. This assurance helps keep capital markets functioning and builds trust in the system. Auditing is guided by three key principles. Independence. The auditor must remain objective and unbiased, with no conflict of interest. Professional skepticism. The auditor must approach every engagement with a questioning mind, looking for evidence that supports or contradicts management's claims. Evidence-based judgment. Conclusions must be supported by sufficient, appropriate evidence, not just intuition or trust. Auditing has evolved over centuries, from verifying records for landowners and monarchs to the modern era of complex multinational audits. Yet the essence has remained the same: seek the truth, test what is presented, and report honestly. In today's world, auditing is more important than ever. Financial scandals, corporate collapses, and economic crises have shown what can happen when numbers cannot be trusted. The auditor's role, to provide clarity and confidence, is vital for investors, regulators, and society at large. Chapter 2. Professional and Ethical Framework. An audit is only as trustworthy as the people who perform it. That is why ethics sit at the very heart of the profession. Stakeholders rely on auditors not just for technical accuracy but for integrity, for the assurance that their judgment cannot be bought, swayed, or compromised. The ethical framework for auditors is built around 5 fundamental principles. Integrity. Always be honest and straightforward even when the truth is uncomfortable. Objectivity. Remain impartial, avoiding bias, conflict of interest, or undue influence. Professional competence and due care. Keep knowledge up to date and perform work diligently. Confidentiality. Protect client information, sharing it only when legally or professionally required. Professional behavior. Comply with laws and regulations and avoid actions that discredit the profession. These principles are not abstract ideals, they are practical guides that shape every decision an auditor makes. For example, if an auditor discovers a significant error in the financial statements, integrity demands that it be reported, even if it might upset the client. If an engagement threatens independence, perhaps because of a close personal relationship with a client executive, objectivity demands stepping back. Ethics also guide professional judgment. Auditors face gray areas all the time, situations where there is no clear right answer. A strong ethical foundation helps them navigate those situations with confidence. Modern auditing standards reinforce these expectations. The International Ethics Standards Board for Accountants, IESBA code, provides a global benchmark for auditor conduct. Many countries also have their own ethical requirements, but they are all built around the same core idea: the public interest comes first. When ethics fail, the consequences can be severe, not just for the client but for the entire profession. Every scandal that involves auditor negligence or misconduct undermines public trust. That is why ethical training, independence checks, and strict quality control systems are built into every reputable audit firm's processes. An ethical auditor is not simply a rule follower, they are a guardian of trust. They have the courage to speak truth to power, the discipline to remain independent, and the wisdom to know when to seek advice. In a profession where credibility is everything, ethics are not optional, they are the foundation. Chapter 3. Audit Planning and Risk Assessment. An audit is not a random exercise. It is a carefully designed journey that begins with a map, the audit plan. Good planning is what separates a focused, efficient audit from one that wastes time chasing minor details. Planning allows auditors to look ahead, anticipate challenges, and decide where to spend their effort so that they can deliver meaningful results. The first step in planning is understanding the organization. Auditors need to go beyond the numbers and learn how the business works. This means understanding what the company sells, how it generates revenue, who its customers are, and what risks could threaten its success. It's not unusual for auditors to meet with management, tour facilities, and even sit down with operational teams to gain insight into how the business runs day to day. Each conversation, each observation builds a clearer picture of where errors, misstatements, or fraud could arise. Once the business is understood, auditors move to risk assessment, the process of identifying where material misstatements are most likely to occur. This is not a guessing game. It is a structured evaluation of the business environment, internal controls, and financial statement areas that might be prone to error. For instance, if a company has complex revenue recognition rules or is under pressure to meet ambitious sales targets, revenue becomes a higher risk area. If inventory is spread across multiple warehouses or includes products that quickly become obsolete, that area demands closer attention. Materiality is a key part of this process. Auditors are not looking for every small error. They focus on those that could influence decisions made by investors, regulators, or other users of the financial statements. Deciding what is material helps them prioritize their work, so that the most significant risks receive the most scrutiny. Another important layer of planning is considering the risk of fraud. Even if no red flags are visible, auditors must always ask, how could someone manipulate these numbers, and who would have the opportunity to do so? This professional skepticism helps them design audit procedures that are more likely to catch unusual transactions or suspicious patterns. From there, the audit team creates two key documents. The audit strategy, which sets the overall direction, how the audit will be approached, what areas are high risk, and whether reliance will be placed on internal controls. The audit plan, which provides detailed instructions on what procedures will be performed, who will perform them, and when they will be done. Good planning does more than improve efficiency. It ensures that the audit team is aligned, that everyone knows their role, and that no significant risk area is overlooked. It also helps manage expectations by communicating with management about what the audit will cover and when they can expect results. In today's fast-changing business world, planning is not a one-time event. It is a living process. As the audit progresses, new information may emerge. A sudden regulatory change, a drop in sales, or a cybersecurity incident, and the plan must be updated. Flexibility is key. Ultimately, planning and risk assessment are about being proactive rather than reactive. They allow auditors to anticipate problems, focus their energy on what matters most, and deliver an audit that truly adds value. Chapter 4: Internal Control Systems. If planning is about setting the course for an audit, internal control is the terrain the auditor must navigate. Internal control systems are the policies, processes, and behaviors that keep an organization running smoothly and protect it from mistakes, fraud, and chaos. They are the organization's safety net, and when they work well, they prevent many problems from ever reaching the financial statements. At its simplest, an internal control system is designed to answer one question: can we trust the information we are looking at? If the answer is yes, auditors can place some reliance on the controls and reduce the amount of detailed testing they need to perform. If the answer is no, they have to dig deeper, often performing more time-consuming substantive procedures. Internal controls operate at many levels. There are entity-level controls, the tone set by leadership, the company's code of ethics, and the culture of accountability. Then there are process-level controls, the checks and approvals built into day-to-day activities such as authorizing payments, reconciling accounts, or reviewing inventory counts. Together, these create a network of safeguards that ideally catch errors early. Auditors use frameworks like COSO, the Committee of Sponsoring Organizations of the Treadway Commission, to evaluate internal control systems. COSO breaks internal control into 5 key components. Control environment, the foundation shaped by leadership's commitment to integrity and ethical behavior. Risk assessment, the process management uses to identify and address risks that could affect objectives. Control activities, the policies, procedures, and approvals designed to reduce risks. Information and communication, the systems that ensure information flows where it is needed. Monitoring, ongoing evaluations to make sure controls are working as intended. When auditors evaluate internal controls, they are asking several key questions. Are controls properly designed to prevent or detect material misstatements? Are they being followed consistently, not just written down in a manual? Are there gaps where errors or fraud could slip through? Sometimes auditors find control deficiencies, weaknesses that need to be addressed. Not every deficiency is severe, but some can be so significant that they must be reported to those charged with governance, or even disclosed publicly. When this happens, the goal is not to point fingers, but to help management strengthen the control environment and reduce risk. Technology has reshaped the world of internal control. Automated systems now handle many transactions, and controls are increasingly built into software. This makes some processes more reliable but also creates new risks, such as cybersecurity threats or system failures. Auditors must understand not just the business processes, but also the IT systems that support them, including access controls, change management, and data integrity. At the heart of internal control is a simple truth: no system is perfect. Even the best designed controls can be overridden by management or bypassed through collusion. That is why auditors cannot rely on controls blindly. They must test them, challenge them, and remain alert to the possibility that something could go wrong. A strong internal control system is not just good for auditors, it is good for the business itself. It reduces errors, prevents fraud, and improves the reliability of financial and operational information. For management, good controls are like a well-built safety net. They provide confidence that the business is operating as intended, and that surprises will be minimized. Chapter 5: Enterprise Risk Management (ERM). Every organization faces risk. Markets shift, competitors innovate, regulations change, and unexpected events can disrupt even the best-laid plans. Enterprise Risk Management (ERM) is about taking control of this uncertainty, not eliminating risk entirely, which is impossible, but managing it in a way that allows the business to achieve its goals with confidence. Think of ERM as a wide-angle lens for understanding risk. Instead of looking at risks in isolation, a fraud risk here, a compliance risk there, ERM looks at the entire picture. It asks, what could stop us from achieving our objectives? And just as importantly, what risks could we take on purpose to create opportunity? At its heart, ERM is a structured process. It begins with risk identification, where organizations map out what could go wrong or right. These risks can be financial, operational, strategic, technological, or even reputational. For example, a company expanding into a new market might face risks related to local laws, supply chains, or political instability. Identifying risks early allows the company to prepare rather than react. Next comes risk assessment, evaluating how likely each risk is to occur and how severe the impact would be if it did. This is often visualized using a risk heat map, where risks are plotted according to their likelihood and impact. High likelihood, high impact risks demand immediate attention, while low likelihood, low impact risks might simply be monitored. Once risks are identified and assessed, management decides how to respond. Avoid the risk. Stop or change the activity that creates the risk. Reduce the risk. Implement controls to lower its likelihood or impact. Share or transfer the risk, for example, by buying insurance or outsourcing. Accept the risk. Consciously decide that the risk is worth taking. Auditors are not responsible for managing risks, that is management's job, but they play a crucial role in providing assurance over the ERM process. They look at whether risks have been identified completely and accurately, whether the assessments are reasonable, and whether controls are actually working as intended. In some cases, they may perform a dedicated ERM review to evaluate the maturity of the risk management process. A mature program does more than protect against threats. It helps businesses seize opportunities. By understanding their risk appetite, how much risk they are willing to take, organizations can make bolder decisions with greater clarity. They can invest in innovation, expand into new markets, or adopt new technology, knowing that they have the systems in place to manage the downside. Auditors have to adapt alongside They must think beyond financial reporting and consider strategic and operational risks that could have financial consequences later. They must understand how links with governance, compliance, and internal control, and they must communicate clearly with boards and audit committees about the organization's most significant risks. In a world that moves fast, is no longer optional. It is a discipline that helps businesses stay resilient, anticipate change, and act with purpose. For auditors, understanding is key to delivering valuable assurance that goes beyond compliance and contributes to the long-term success of the organization. Chapter 6: Information Technology and Audit. Business today is inseparable from technology. Whether it's processing payroll, tracking inventory, managing customer relationships, or preparing financial statements, IT systems are at the heart of almost every process. For auditors, this means understanding technology is no longer optional, it's essential. Information technology brings speed, accuracy, and efficiency to business operations, but it also introduces new risks. A single system failure, a cyber attack, or even a simple configuration error can have a massive financial impact. Auditors must not only look at the numbers produced by IT systems, but also examine the systems themselves to make sure the numbers can be trusted. When auditors talk about IT, they often start with IT general controls, ITGCs, the foundation of a reliable technology environment. These controls cover areas such as access management, ensuring that only authorized people can get into critical systems, and that permissions are removed when employees leave. Change management, making sure that software updates, system changes, and patches are properly tested and approved before going live. Backup and recovery, protecting data in case of hardware failure, cyber incidents, or natural disasters. IT operations, monitoring systems to ensure they run smoothly and securely. If these general controls are weak, it doesn't matter how well the rest of the audit is performed, the data itself may be unreliable. That's why auditors often work with IT specialists to test these controls early in the engagement. Beyond ITGCs, auditors also look at application controls, the automated checks built into systems to prevent or detect errors. For example, a system might automatically reject a journal entry that doesn't balance or flag an invoice that exceeds a certain threshold. These controls can be highly effective, but only if they are designed correctly and operating as intended. Another major development in auditing is the rise of data analytics. Instead of testing small samples of transactions, auditors can now analyze entire populations of data using advanced tools. This allows them to spot unusual patterns, identify trends, and focus their work where anomalies are most likely to occur. For example, they might scan all vendor payments to detect duplicate invoices or review every journal entry posted near year-end for unusual amounts. But technology creates new challenges too. Cybersecurity risk is a growing concern, and auditors must understand how breaches could affect financial reporting or operations. Cloud computing raises questions about who owns the data and who is responsible for controls. Artificial intelligence and machine learning can automate decision-making, but auditors must ensure those decisions are transparent and free from bias. IT auditing is not about becoming a software engineer. It's about knowing enough to ask the right questions and test the right things. Auditors must bridge the gap between financial expertise and technology understanding, often collaborating with IT auditors and cybersecurity professionals to gain a full picture. Ultimately, auditing in the digital age means adapting to a new reality. The audit of the future will rely more on continuous monitoring, real-time data analysis, and technology-driven insights. The auditors who thrive will be those who embrace technology rather than fear it, using it to enhance assurance and deliver deeper, more timely insights to stakeholders. Chapter 7: Audit Evidence and Sampling. At its core, an audit is about building a case that supports the opinion the auditor will eventually give. And just like a lawyer in court, an auditor needs evidence. Without evidence, even the most persuasive opinion is worthless. Audit evidence is everything the auditor gathers to support their conclusions. It can take many forms: documents, confirmations from third parties, observations, calculations, or even verbal explanations from management. But not all evidence is created equal. Some evidence is more reliable than others. For example, a bank confirmation sent directly to the auditor is generally more trustworthy than a number provided by management. The art of auditing lies in collecting enough evidence, of sufficient quality, to reach a conclusion with reasonable assurance. This doesn't mean absolute certainty, that would be impossible, but it does mean gathering enough proof to be confident that the financial statements are free from material misstatement. Because businesses generate massive amounts of transactions, auditors rarely look at every single one. Instead, they use sampling, selecting a subset of transactions to test, then using the results to draw conclusions about the entire population. Sampling saves time and money, while still giving a high level of confidence. There are two main approaches to sampling. Statistical sampling, which uses mathematics and probability theory to ensure that the sample is representative. This method allows auditors to quantify the level of confidence they have in their results. Non-statistical or judgmental sampling, which relies more on the auditor's experience and professional judgment to select items that are likely to reveal problems. Both approaches have their place. For example, an auditor might use statistical sampling for testing routine transactions like sales invoices, but rely on judgmental sampling to select unusual or high-value transactions for closer review. Audit evidence comes from many sources. Some of the most common include inspection of documents and records, reviewing invoices, contracts, and other written evidence. Observation, watching how a process is performed, such as witnessing an inventory count. External confirmations, obtaining information directly from third parties, banks, customers, suppliers. Recalculation and reperformance, independently verifying the accuracy of calculations or controls. Inquiry, asking questions of management and employees, but always seeking corroboration from other evidence. The key challenge is deciding when enough is enough. Auditors must balance efficiency with thoroughness. Collecting too little evidence risks missing a material misstatement, while collecting too much wastes time and resources. This is where professional judgment comes in, guided by auditing standards and the concept of materiality. Technology is transforming how evidence is gathered. With data analytics, auditors can now examine entire populations rather than just samples, drastically increasing coverage and potentially identifying issues that traditional sampling might miss. Automated tools can flag anomalies, perform reconciliations, and even rerun controls in real time. But even with advanced tools, the auditor's role remains critical. Evidence must be interpreted, inconsistencies must be investigated, and conclusions must be drawn carefully. Gathering evidence is not just about collecting data, it's about telling a story that supports the final audit opinion. When done well, this process provides a solid foundation for assurance. Stakeholders can trust that the opinion given at the end of the audit is backed by a mountain of carefully considered, high-quality evidence. Chapter 8: Substantive Procedures and Analytical Review. Once the auditor has planned the audit, assessed risk, and considered the strength of internal controls, it's time to roll up their sleeves and get into the heart of the work: substantive procedures. These are the tests that provide direct evidence about whether the numbers in the financial statements are fairly stated. Substantive procedures come in two main forms: tests of details and substantive analytical procedures. Tests of details involve examining individual transactions, balances, and supporting documents. For example, the auditor might select a sample of sales invoices to verify that revenue was recorded correctly, or check vendor statements to confirm accounts payable balances. These procedures provide concrete transaction-level evidence and are particularly useful for high-risk areas where precision matters. But looking at individual transactions is only part of the picture. Auditors also step back and ask, do these numbers make sense? This is where analytical review comes in. Analytical procedures compare financial data with expectations, either based on historical trends, industry benchmarks, or relationships between different accounts. For example, if sales increased by 20% from last year, did the cost of goods sold increase by a similar percentage? If payroll expense stayed the same but the company hired more staff, does that make sense? If inventory grew significantly, is there a corresponding increase in sales, or is inventory piling up? Analytical procedures are powerful because they can quickly highlight unusual patterns that might indicate errors or fraud. They are also efficient. Rather than testing hundreds of transactions, an auditor can perform an analysis to identify which areas deserve deeper investigation. Substantive procedures often vary depending on the financial statement area being tested. Revenue might be tested with a mix of detailed transaction testing and analytical procedures, comparing sales trends to prior periods. Inventory might require physical observation of counts, price testing, and review of valuation adjustments for slow-moving or obsolete items. Liabilities and provisions often involve reviewing subsequent payments, legal correspondence, and management's estimates. Professional judgment is critical here. Auditors must decide how much testing is needed, which procedures will provide the most reliable evidence, and how to follow up when something doesn't look right. If an analytical review shows a result outside of the expected range, the auditor must dig deeper, perhaps by increasing the sample size, requesting additional explanations, or performing alternative procedures. Technology is also reshaping substantive work. With modern audit software and data analytics, auditors can now perform more comprehensive testing. Instead of sampling a small subset of transactions, they can analyze the entire population, searching for duplicates, unusual entries, or patterns that might signal manipulation. This approach allows auditors to focus on exceptions and outliers, improving efficiency and coverage. Substantive procedures are where planning, risk assessment, and professional skepticism come together. They are the proof that supports the auditor's conclusion. A well-executed set of substantive tests gives confidence not only to the auditor, but to shareholders, regulators, and anyone relying on the financial statements. Ultimately, substantive work is not just about ticking the boxes. It's about building a story supported by evidence that the financial statements reflect reality. And when the story doesn't add up, it's about digging until the truth is clear. Chapter 9: Group Audits and Component Auditors. Modern businesses rarely operate as a single, standalone entity. Many are part of complex groups with subsidiaries, joint ventures, and divisions spread across multiple countries. Auditing such groups is not just a bigger version of a single entity audit, it is a different challenge altogether. It requires coordination, communication, and a careful balance of trust and verification. In a group audit, one firm is responsible for expressing an opinion on the consolidated financial statements. This firm, called the group auditor, must consider the work of other auditors, known as component auditors, who handle parts of the business. These component auditors might be located in different cities, countries, or even continents, and they may belong to different networks or firms entirely. The first step in a group audit is understanding the group structure. The group auditor must map out which entities are significant to the consolidated results, which are immaterial, and which carry unique risks. Some subsidiaries may contribute the bulk of the group's revenue or assets, and therefore require extensive audit work. Others might be small, but present a specific risk. For example, a subsidiary operating in a country with high corruption risk might need special attention even if its financial contribution is small. Once the group auditor understands the structure, they determine the scope of work for each component. They decide whether they will perform the work themselves, rely on the component auditor's work, or perform additional procedures to gain comfort over the results. This is where communication becomes critical. The group auditor sends detailed instructions to component auditors, outlining what procedures need to be done, what materiality levels to use, and how results should be reported back. Relying on component auditors requires trust, but trust must be earned. The group auditor evaluates the competence and independence of each component auditor before relying on their work. In some cases, they may review the component auditor's working papers or perform their own tests at the component level to confirm key balances. Coordination is one of the biggest challenges in group audits. Different time zones, languages, accounting systems, and local regulations can make communication difficult. The group auditor must keep everyone aligned, resolve issues promptly, and ensure that deadlines are met so the consolidated financial statements can be issued on time. Group audits also carry a heightened level of risk. Misstatements in one component can affect the entire group. For example, if one subsidiary fails to eliminate intercompany transactions properly, it could distort group revenue and expenses. If a component auditor misses a significant risk, it becomes the group auditor's problem. That is why group auditors remain ultimately responsible. They cannot simply disclaim responsibility by saying, "The component auditor handled it." Technology has improved the process by allowing secure sharing of data, real-time collaboration, and remote reviews. But it has also created new complexities around data privacy and cybersecurity, especially when information crosses borders. At the end of the process, the group auditor brings together all the pieces, the results from each component, to form an overall opinion on the consolidated financial statements. This role is as much about coordination and judgment as it is about technical audit work. A well-run group audit is like conducting an orchestra. Each component auditor plays their part, but it is the group auditor's job to make sure the entire performance is harmonious. When done right, the result is a clear, credible picture of the group's financial health, one that stakeholders around the world can rely on. Chapter 10: Audit of Financial Institutions. Auditing a financial institution is unlike auditing any other type of business. Banks, insurance companies, and investment firms operate under strict regulation, handle enormous volumes of transactions, and carry risks that can have far-reaching effects on the economy. When auditors step into this world, they are not just providing assurance for shareholders, they are helping protect the stability of the entire financial system. The first thing that makes financial institutions unique is their balance sheet. For a manufacturing company, assets might consist of factories and inventory. For a bank, assets are mostly loans and investments, numbers on a screen rather than physical items. This means that much of the audit focuses on valuation. Are those loans really collectible? Are those investments worth what they are recorded at? Small changes in assumptions can have a huge impact on reported results. Take loan portfolios for example. Auditors must evaluate credit risk, the likelihood that borrowers will default. This involves reviewing the bank's credit policies, examining samples of loans, and assessing whether provisions for bad debts are adequate. In times of economic stress, this work becomes even more critical, as rising defaults can quickly erode a bank's capital. Financial institutions are also highly regulated. Banks must meet capital adequacy requirements, maintain liquidity ratios, and comply with anti-money laundering (AML) laws. Auditors often perform additional procedures to confirm compliance with these regulations, knowing that violations could result in fines, reputational damage, or even license revocation. Another unique area is derivatives and complex financial instruments. These can be difficult to value, as they often rely on models and market assumptions. Auditors may bring in valuation specialists to challenge management's models, test key inputs, and verify that disclosures in the financial statements are clear and complete. Because financial institutions process millions of transactions, IT systems play a central role in the audit. Auditors must evaluate system controls, test data integrity, and sometimes rely on automated tools to analyze vast amounts of data quickly. A single system error could misstate interest income or customer balances across thousands of accounts. Fraud and misconduct risks are also elevated in financial institutions. Auditors must remain alert to potential manipulation, whether it's misstating loan quality, hiding losses, or engaging in improper trading activities. Professional skepticism is crucial, as history has shown that when financial institutions fail, the consequences can be devastating. Finally, communication with regulators is a distinctive feature of these audits. In many jurisdictions, auditors are required to report certain findings directly to banking supervisors or other regulatory bodies. This makes transparency and objectivity even more important. Auditing financial institutions is challenging, but it is also rewarding. It requires a deep understanding of accounting, finance, regulation, and risk management. It calls for collaboration with specialists in IT, credit risk, and valuation. And most importantly, it demands a commitment to serving the public interest, because the health of these institutions affects far more than just their shareholders. A well-executed audit of a financial institution gives confidence not only to investors, but also to depositors, regulators, and the public at large. In a world where trust in the financial system is essential, that confidence is priceless. Chapter 11: Audit of Public Sector Entities. Auditing in the public sector is a different world from auditing private companies. Here, the objective is not just about profit and shareholder value, it's about accountability, transparency, and ensuring that public money is used wisely. Public sector entities include government departments, state-owned enterprises, municipalities, and agencies that provide essential services like education, healthcare, and infrastructure. The first big difference is the stakeholder base. In a private company, the primary audience for an audit is the shareholders. In the public sector, the audience is much broader: legislators, regulators, taxpayers, and the public itself. Every dollar comes from public funds, and there is a heightened expectation that it is spent efficiently, lawfully, and for the intended purpose. This leads to a broader audit scope. While private sector audits focus mainly on whether the financial statements are free from material misstatement, public sector audits often go further. They may include compliance audits, checking whether the entity has followed relevant laws, regulations, and policies. Performance audits, assessing whether programs are achieving their objectives and whether resources are being used efficiently and effectively. Value for money audits, determining whether taxpayers are getting the best possible outcome for the money spent. Another unique feature of public sector auditing is the presence of supreme audit institutions, such as national audit offices or auditors general. These independent bodies are responsible for auditing the government's financial statements and reporting their findings to Parliament or Congress. Their role is crucial in holding governments accountable to citizens. Auditing public sector entities comes with unique challenges. Government programs can be complex, spanning multiple agencies and jurisdictions. Funding might come from different sources: taxes, grants, international aid, each with its own rules. Auditors must navigate this complexity while remaining independent and objective, even when their findings may have political consequences. Ethics and public trust are especially important in this setting. Any perception of bias or lack of independence can undermine confidence not just in the audit, but in government as a whole. That is why public sector auditors operate under strict professional and ethical standards, often similar to those in the private sector, but with additional emphasis on transparency and impartiality. Technology is also transforming public sector auditing. Data analytics allows auditors to analyze large volumes of transactions, for example, all government procurement contracts, to identify unusual patterns, potential fraud, or inefficiencies. Performance audits are increasingly using outcome-based data to measure whether public programs are delivering the results they promised. One of the most significant contributions of public sector auditing is its ability to drive improvement. When audit findings lead to better controls, reduced waste, or improved service delivery, citizens directly benefit. This makes the work highly impactful. A strong audit can lead to better schools, safer roads, or more reliable healthcare systems. In short, auditing public sector entities is not just a technical exercise. It is an act of public service, a way of strengthening democracy by ensuring that governments are held accountable. When done well, it shines a light on how public resources are managed and helps build trust between governments and the people they serve. Chapter 12: Audit of Nonprofit Organizations. Nonprofit organizations, NPOs, are driven by purpose rather than profit. They exist to serve communities, advance causes, or provide public benefit, whether through education, healthcare, charity, or advocacy. But their noble mission does not exempt them from scrutiny. In fact, because they rely heavily on public trust and donor funding, the role of audit is just as critical, sometimes even more so, than in the corporate world. The first key distinction is that the focus is not on profit, but on stewardship of resources. Donors, grant providers, and stakeholders want to know that funds are being used responsibly and in alignment with the organization's mission. Auditors must ensure that the financial statements present a fair picture of how resources were received, spent, and managed. This often involves dealing with restricted funds, money given by donors with specific conditions attached. For example, a donor might provide $1 million to build a school, but prohibit its use for administrative expenses. Auditors must verify that these restrictions have been honored, and that funds have been applied to the intended programs. Misuse of restricted funds can damage an organization's reputation, and even lead to legal action. Another challenge is the nature of NPO revenue. It might come from diverse sources: donations, grants, membership fees, fundraising events, each with different recognition rules. Auditors must check that contributions are recorded in the correct period, and that in-kind donations, such as donated goods or volunteer services, are measured and disclosed appropriately. Internal controls in nonprofits can also be a concern. Many organizations operate with limited staff and rely heavily on volunteers. This can lead to weaker segregation of duties, making them more vulnerable to errors or fraud. Auditors often spend extra time assessing controls and recommending improvements, not just to protect assets, but to strengthen accountability. Because NPOs are mission-driven, performance reporting is increasingly important. Stakeholders want to know not just where the money went, but what impact it achieved. Auditors may be asked to review or assure performance metrics, such as the number of people served, outcomes achieved, or progress toward program goals, to give donors confidence that their contributions are making a real difference. Ethics and reputation are central concerns. Even a small financial misstatement or control failure can erode public confidence and threaten future funding. Auditors must approach their work with sensitivity, professionalism, and a deep understanding of the organization's mission. Technology and data analytics are helping here too. Modern auditing tools can track donation flows, match expenditures to funding restrictions, and flag unusual transactions. This not only improves audit quality, but also helps NPOs strengthen their governance. Ultimately, the audit of a non-profit organization is about building trust. It reassures donors that their contributions are making a difference, assures regulators that compliance obligations are being met, and provides boards with the information they need to make better decisions. A well-conducted audit helps an NPO focus on what really matters, its mission, by removing doubts about its financial integrity. In this way, auditors become silent partners in advancing causes that improve society. Chapter 13: Forensic Audits and Investigations. Sometimes an audit is not just about checking numbers, it becomes an investigation. When suspicions arise about fraud, corruption, or financial misconduct, auditors may be called upon to shift from routine assurance work to forensic auditing. This is the investigative arm of the profession, where accounting meets detective work. Forensic audits go beyond expressing an opinion on financial statements. Their goal is to uncover the truth, to determine whether wrongdoing occurred, how it happened, who was involved, and how much damage was done. This requires a very different mindset from a standard audit. While traditional auditors look for reasonable assurance that the financial statements are free from material misstatement, forensic auditors often assume that something is wrong and search for evidence to confirm or disprove it. A forensic audit may be triggered by many events: unexplained losses, whistleblower reports, regulatory inquiries, or even tips from employees. The process begins with scoping the investigation, understanding what allegations exist, what time period and transactions are relevant, and what objectives the client or court expects. Gathering evidence is central to forensic work. This might include document review, invoices, bank statements, contracts, emails, and accounting records. Data analytics, searching for unusual patterns, such as duplicate payments, round-dollar transactions, or entries made outside of normal business hours. Interviews, speaking with employees, management, and third parties to piece together the facts. Digital forensics, recovering deleted files, tracking user access logs, or extracting data from devices. Unlike a typical audit, where sampling is common, forensic audits often involve a deep dive into specific transactions. Investigators may trace funds through multiple accounts, reconstruct events step by step, and look for inconsistencies in explanations. The work can be meticulous and time-consuming, but every detail can matter, especially if the case ends up in court. Confidentiality and independence are critical. Forensic auditors must remain objective, avoid conflicts of interest, and handle evidence carefully to preserve its integrity for legal proceedings. They may also work closely with legal counsel, regulators, or law enforcement agencies, ensuring that findings are admissible and defensible. The outcome of a forensic audit is typically a detailed report that sets out the facts, evidence, and conclusions. This report may be used in litigation, disciplinary action, insurance claims, or regulatory enforcement. In some cases, forensic auditors may even testify as expert witnesses, explaining complex financial matters to judges and juries. Forensic audits are not only about catching wrongdoers. They often reveal weaknesses in internal controls, gaps in governance, or cultural issues that allowed the misconduct to happen in the first place. By addressing these root causes, organizations can emerge stronger and better protected against future fraud. Perhaps the most important quality for a forensic auditor is professional skepticism, the willingness to question everything, dig deeper, and follow the evidence wherever it leads. When done well, forensic audits shine a light on the darkest corners of an organization, restore trust, and help deliver justice. Chapter 14: Internal Audit and Risk Management. If external auditors are the independent watchdogs looking in from the outside, internal auditors are the sentinels working from within. Their mission is not just to review financial statements, but to strengthen the entire governance and risk management framework of the organization. Internal audit is a crucial part of the 3 lines of defense model. Management is the first line, responsible for owning and managing risks. Risk and compliance functions are the second line, providing oversight and guidance. Internal audit serves as the third line, offering independent assurance that risks are being managed effectively and that controls are working as intended. Unlike external auditors who report to shareholders, internal auditors typically report to the board's audit committee. This reporting line ensures independence from management and gives internal auditors the authority to investigate sensitive areas. Their work is guided by the International Standards for the Professional Practice of Internal Auditing, IPPF, which emphasizes objectivity, independence, and a systematic approach. Internal audit scope is broad. It includes operational audits, reviewing business processes for efficiency and effectiveness. Compliance audits, ensuring that laws, regulations, and internal policies are followed. Financial audits, checking the accuracy of accounting records and controls. IT audits, assessing cybersecurity, data integrity, and system controls. Risk-based audits, focusing on areas of highest risk from fraud to supply chain disruption. Risk management is closely tied to internal audit. Every organization faces risks: strategic, financial, operational, and reputational. Risk management is the process of identifying, assessing, and responding to those risks. Internal auditors evaluate whether management has done this effectively. Are risks being identified proactively? Are mitigation strategies realistic and monitored? Are emerging risks, such as cybersecurity threats or climate risks, being addressed? An effective internal audit function doesn't just point out problems, it adds value. Its goal is to improve operations, strengthen controls, and help the organization achieve its objectives. A great internal auditor is part detective, part consultant, and part advisor, able to challenge management constructively while maintaining independence. Technology is playing an increasing role in this space. Continuous auditing and monitoring tools allow internal auditors to test transactions in real time rather than months after the fact. Data analytics enables them to spot anomalies, trends, and red flags across massive datasets. These tools shift the focus from retrospective detection to proactive risk prevention. Internal audit also plays a key role during times of crisis. Whether it's a major fraud investigation, a cybersecurity breach, or a global pandemic, internal auditors help boards and executives understand where risks are emerging fastest and what controls need to be reinforced. Ultimately, internal audit and risk management work hand in hand to build resilience. They ensure that the organization is not just reacting to problems, but anticipating them, ready to navigate uncertainty and adapt to change. When internal audit functions at a high level, it fosters a culture of accountability, transparency, and continuous improvement. It becomes a trusted advisor to the board, a partner to management, and a guardian of the organization's integrity. Chapter 15: Emerging Trends in Audit and Assurance. The world of audit and assurance is evolving faster than ever. What was once a profession rooted in manual sampling, paper files, and checklists is now being reshaped by technology, global risks, and changing stakeholder expectations. The auditor of the future will look very different from the auditor of the past, more data analyst, risk strategist, and communicator than box ticker. One of the biggest drivers of change is technology. Artificial intelligence, AI, and machine learning are transforming how audits are performed. Instead of sampling a small number of transactions, auditors can now analyze entire populations, flagging unusual items for follow-up. Predictive analytics can identify patterns that suggest fraud or errors before they materialize into major problems. AI-driven tools are even capable of reading contracts, extracting key terms, and highlighting risks automatically. Another disruptive force is blockchain technology. As more companies adopt blockchain for recording transactions, auditors will have access to real-time tamper-proof records. This could radically reduce the need for certain types of testing. If the blockchain itself is secure, the data may be inherently reliable. However, this also requires auditors to gain new skills, including the ability to evaluate blockchain protocols and cybersecurity risks. Stakeholder expectations are shifting too. Investors, regulators, and the public increasingly demand assurance beyond traditional financial statements. ESG, environmental, social, and governance reporting is one of the fastest-growing areas of assurance. Companies are disclosing information on carbon emissions, diversity metrics, and governance practices, and auditors are being asked to verify these disclosures. This introduces new challenges, as ESG metrics often involve forward-looking data, estimates, and non-financial information. The rise of sustainability assurance highlights a broader trend. The auditor's role is expanding from simply verifying numbers to providing trust across all types of information. This could include cybersecurity readiness, supply chain integrity, or even ethical sourcing of materials. Globalization and remote work are also influencing how audits are done. Virtual collaboration tools allow teams to work across borders more easily, but they also raise questions about data privacy, security, and jurisdiction. Regulators are responding with stricter standards on quality management, requiring firms to invest in systems that ensure consistency and reliability across their global networks. Perhaps the most profound trend is the shift from hindsight to foresight. Traditional audits are backward-looking. They tell you what happened last year. Emerging tools and techniques are helping auditors move toward continuous assurance, providing insights in near real time. Boards and management can use these insights to respond quickly to risks, rather than waiting until after year-end. With all these changes, the skills required of auditors are evolving. Future auditors will need to be comfortable with coding, data visualization, and technology platforms. They will need to understand climate risk, cybersecurity, and global supply chains. Soft skills will matter just as much. Communication, critical thinking, and the ability to explain complex findings in plain language will be crucial for building trust with stakeholders. The future of audit is exciting. Far from becoming obsolete, the profession is becoming more relevant, providing assurance not just on financial statements, but on the broader ecosystem of information that drives decisions in business, government, and society. In a world awash with data and misinformation, the need for trusted, independent assurance has never been greater. Chapter 16: The Future Auditor's Role and Skills. As we look ahead, the role of the auditor is at a crossroads. The profession has come a long way from the days of ledger books and manual tick marks. Today's auditor operates in a fast-paced, data-rich environment where stakeholders demand more insight, more transparency, and more value. The question is no longer just, are the numbers right, but can we trust this organization, its reporting, and its future? The auditor of the future will need to be more than a technical expert. They will be a strategic partner, a risk navigator, and a trusted storyteller. They will help organizations anticipate challenges, strengthen governance, and build resilience. To do this, they will need a unique blend of skills, both technical and human. On the technical side, auditors must become fluent in data analytics, artificial intelligence, and automation. Instead of manually sampling a few transactions, they will need to work with massive datasets, spotting anomalies and trends that may signal risk. They will need to understand blockchain, cloud systems, and cybersecurity so they can evaluate not just financial data, but the systems that generate and protect it. But technical expertise alone will not be enough. The future auditor must also be a skilled communicator. The ability to explain complex findings clearly to boards, regulators, investors, and the public will be just as important as performing the procedures themselves. An audit report will not simply be a formal opinion, it will be a narrative that helps stakeholders understand risk, performance, and opportunity. Ethics and independence will remain at the heart of the profession. As technology increases efficiency, the temptation to cut corners or rely too heavily on automation may grow. Future auditors will need to exercise professional skepticism and maintain integrity even in the face of pressure. In a world where misinformation spreads quickly, being seen as a source of unquestionable truth will be the profession's greatest strength. The auditor of the future will also need to be adaptable. Risks evolve: cyber attacks, climate change, geopolitical instability, AI-driven fraud, and so must the audit approach. Continuous learning will be essential. Tomorrow's auditors will not just follow checklists, they will innovate, experiment, and stay ahead of emerging threats. Finally, the future auditor must be purpose-driven. Audit and assurance are public interest professions. At their best, they protect investors, strengthen markets, safeguard public funds, and enhance trust in institutions. In a world facing economic uncertainty, social tension, and environmental crises, this mission has never been more important. In many ways, the future auditor will be the guardian of trust, a professional who not only validates information but also provides insight, foresight, and confidence. The profession is evolving, but its core promise remains unchanged: to bring clarity where there is doubt, assurance where there is risk, and integrity where it matters most. Epilogue: The Unseen Guardians. Auditing has never been glamorous. It rarely makes headlines when done well, and yet it quietly holds the financial world together. Each chapter of this book has explored a different facet of audit and assurance, from gathering evidence to managing risk, from investigating fraud to embracing technology. Together, these pieces form a bigger picture, the story of a profession that safeguards trust. The work of auditors is often invisible to the public. Most people will never see the hours spent testing controls, analyzing data, or challenging management's assumptions. They may not know the debates that happen in audit committees, or the judgment calls that determine whether a misstatement is material. But they feel the results: in stable markets, in trustworthy financial reports, and in confidence that businesses, governments, and charities are held accountable. This is the true power of audit. It creates confidence in an uncertain world. And as the world grows more complex, with faster data, smarter technology, and bigger risks, the role of the auditor becomes even more essential. Auditors are, in many ways, the unseen guardians of transparency. They are the quiet force standing between chaos and order, between rumor and fact, between suspicion and assurance. Their work empowers investors to take risks, governments to allocate resources, and citizens to trust that the systems around them are functioning as they should. As we close this journey, remember that audit and assurance are not just technical disciplines, they are acts of service. They protect not just numbers but people. And they remind us that in business, as in life, trust must be earned and safeguarded day after day, year after year. The future will bring new challenges, new risks, new technologies, and new expectations. But the core mission of audit will endure: to tell the truth with courage, to uphold integrity, and to give society the gift of confidence. And that, perhaps, is the most important assurance of all.